Hi, this is Utkarsh Jain and we are on to the part 2 of 60-minute guide to accounting. Now before we proceed, let's do a quick recap of what we studied in the previous section. We tried to understand certain important definitions. The first one was that what was accounting? We simply say that it was about recording, classifying and summarizing business transactions. And then what were business transactions? These were simple business activity where some sort of an exchange was involved. And then finally, we said that what were financial statements, and then we tried to answer saying that the financial statements are primarily three: balance sheet, income statement and cash flow. Balance sheet is about assets and liabilities, income statement is about income and expenditure, and cash flow statement is about the cash inflow and cash outflow of an organization. Now in this section, we are going to try to classify certain items into four separate categories. That is, there would be multiple items and then we would try to classify them into either assets, liabilities, income or expenditure. And during the process of classification, we would try to understand certain vital background concepts of accounting. So let us start. Our job is to classify the items into four categories, either income, expense or asset or liability. The first item is sales. Now obviously, sales we will have to classify into the category of income. That means in case if you are preparing a balance sheet and income statement, sales would be shown on the income statement, on the income side of the income statement. Next item is plant and machinery, which is an economic resource for an organization, which would be classified as an asset. Next item would be a bank loan. Bank loan is a liability because a company and organization would owe it, therefore we would classify it as a liability of the organization. Interest paid, obviously it has to be a expenditure, so interest paid is an expenditure. Next item is salary. Salaries paid would again be an expenditure. Generally there would not be a salary received item into a profit and loss account or balance sheet. The reason being that the financial statements are prepared for a business organization, not for a salaried employee. So generally we would not see something called as salary received, and therefore in accounting, every time if it is said as salary, it is always interpreted that it is salary paid, not received. Next item is cash. It's an economic resource, therefore we would classify this as an asset. Now this is important. It says capital. Meaning of capital is the amount of money that owners of the business have contributed towards the business. Now, what is capital? Is it an asset or is it a liability or is it an expense or income? Now, to understand this, we need to understand a background concept in accounting, and that concept is called as business entity concept. Now, what is the meaning of business entity? The owner of the business, the promoters of the business and the business itself for accounting purpose are considered as separate legal entities. So what does it mean? Let's say that this is the promoter of a particular business. This is the promoter and this is the business, which means that business and the promoters are considered as different entities from the accounting point of view. So when this is the owner and this is the business. So when owner of a business decides to invest some amount, so let's say that owner decided to invest $10 million into this business. The business would say that I have received this money from the owner and sooner or later I would be required to pay back this money, and therefore this is a liability on the balance sheet of the business, because the business would say that sooner or later I have to pay back this money to the owner of the business. Now, keeping the same concept in mind, let us assume that business made a profit of, let's say, $2 million in year one. Now, the way business would think is that I have made this profit, but this profit belongs to the owners of the business. And the fact that this profit have not been paid to the owners in cash yet, this profit still lies with me. I am supposed to pay it back to the owner. So originally my liability towards the owner was $10 million. Now I've made profit of additional $2 million. So my total liability is $2 plus 10, that means total liability is $12 million towards the business. Which means that every time business makes profit, the amount that it owes to the owners of the business is going to increase, and that is precisely the reason why when the profit of a business organization is transferred to its balance sheet on the liability side because of a concept called as business entity concept. So the answer to our question is that what is capital? Capital is simply a liability. Next item would be patent. Now, patent is an economic resource which would help an organization to generate revenue. Though this is something that cannot really be seen or felt or touched, but it is still an asset. Therefore, we would classify patent as an asset. But now, what is the difference between an asset like a plant and machinery and patent? A plant and machinery is something that can be seen, felt or touched, and therefore these kind of assets we generally call as tangible assets. Whereas a patent is something that cannot be seen, but all of us know that it exists, and therefore this kind of an asset would be called as intangible asset. Next item is rent received. Since we've received the rent, that means the business must have given some property on rent. Therefore, this is an income of the business. So rent received would be an income. And now the next and very important item called as prepaid rent. Now rent received was classified as income. Had there been any rent paid, that rent paid would have been classified as an expenditure. But what is the meaning of prepaid rent? And to understand the true meaning of prepaid rent, we need to understand a very important background concept called as the accrual system of accounting. This is the base on which the modern day accounting system is based. Accrual system of accounting, and this accrual system of accounting is to be compared with cash system of accounting. Cash system of accounting. And just for simplicity and understanding purpose, I'm going to write down this as a very old system of accounting which is not used so extensively anymore, whereas accrual system of accounting is the modern accounting or modern system based on which the entire modern accounting is based. Now, what is the meaning of this word accrual? So let's do an example. Let us say that we are owning a business and we are supposed to pay a rent of, let us say, 10 or $1 million every year. This is the amount of rent that we are supposed to pay every year. Now we will consider three possible scenarios. Scenario number one, that this year we were supposed to pay 1 million in cash and we actually paid 1 million in cash. We were supposed to pay 1 million and we paid 1 million. Scenario number two, that we were supposed to pay 1 million, but let us assume that we had some excess amount of cash flow and we decided that let us pay 1 million rent of this year. Let us also pay 0.5 million rent of next year in advance itself. That means the amount of cash paid towards the rent is 1.5 million. And scenario number three, that we were supposed to pay 1 million, but let's assume that we were some short of cash in this particular year, and therefore we decided that this year we would pay in cash only $0.5 million and the remaining amount would be paid subsequent year. That means next year we will pay 1.5. Now, if we have paid 1 million in cash and we were supposed to pay 1 million, so we would simply say that amount of expenditure which is to be shown as rent paid would be simply $1 million. So 1 million. In scenario number two, we were supposed to pay 1 million, but we've paid 1.5 in cash. Now the amount of expenditure is going to be, it's not going to be 1.5. The amount of expenditure is going to be $1 million because of the concept called accrual system of accounting. So what does it say? It says that amount of cash paid is not important while considering what is the income or what is the expenditure. What is important is what is the amount of expense which has been incurred. So no matter what is the amount of cash that we paid in this year, we have consumed the services worth 1 million, we have occupied the property, and the charges towards that occupation was 1 million. So even though we've paid 1.5 in cash, our expenditure in this year is going to be only 1 million. So then what happens to that extra 0.5 million? Since we've paid it, so that next year we don't have to pay 1 million anymore, we are going to pay only 0.5. That means at this stage, this is some sort of a economic resource, and therefore remaining 0.5 million is to be shown as an asset. So there would be an asset, and that asset would be called as prepaid rent. An amount of prepaid rent is going to be 0.5 million. Now scenario number 3, that we were supposed to pay 1 million, we paid only 0.5 million, and therefore the amount of expenditure is not going to be 0.5 million. The amount of expenditure is not 0.5, the amount of expenditure is still 1. Amount of cash which has been paid is not important for finding out the expense. What is important is that what is the amount of expenditure which has been incurred during the year, which means that we've consumed the property, we have occupied the property, and the charges towards it were worth 1 million, and therefore the expenditure is going to be 1. But the fact that we paid only 0.5, that means we are supposed to pay this year's 0.5, and next year we'll have to pay next year's 1. So this year we have a liability, and the amount of liability is going to be 0.5. So what does it mean? It means that no matter how much cash I pay, 1 million, 1.5 million or 0.5 million, the amount of expenditure is always going to be the amount of services that I've consumed. That means the amount of income that I've incurred, amount of expense that I've incurred, and it is 1 million, 1 million and 1 million due to the concept called as accrual system of accounting. Now the same logic applies even for the income. So let us say that we are in the business of, we are consulting, and we have a client who is supposed to pay us every year a consulting fee of, let us say, $100,000. This is the amount of income that we are supposed to receive every year. Now again we consider 3 scenarios, that the client actually pays in cash $100,000, client pays in cash $150,000, and client pays in cash only $50,000. Now going by the accrual system, that no matter how much cash has been received, what would be the amount of income? The amount of income would be the income earned. That means we've given services worth $100,000, so our income is going to be exactly $100,000 in all the 3 scenarios. Then how do you adjust the remaining amount? Since we've received extra, so we are liable to give services next year, so my income would be $100,000 and liability in scenario number 2 would be $50,000. Here we've received only 50,000, we were supposed to receive 100,000, which means that next year we are going to receive extra, so income would be $100,000 and there would be an asset, and that asset would be called as consulting fee receivable, or at times it is called as accounts receivable, and that amount would be $50,000, which means that no matter how much is the cash received, what is important is that what is the amount of income which has been earned, and in all the cases that amount of income which has been earned is $100,000. The part 2 of 60-minute guide to accounting ends here. See you in the next part. Thank you.